It merely reflects a strong US economy. Alan Greenspan encouraging, et cetera, right through until today. They don't realize that they're playing with such fire. My second point, high levels of debt are just far too often seriously dangerous and should be, in general, discouraged actively. That should be one of the responsibilities of top management, including the Fed, et cetera. And let me just give you an example. Why do you like low rates? Because it encourages debt. Why do you like more debt? Because it encourages growth. That's the argument. So let me give you the ultimate statistical test of that. We start in 1985, and we have been modestly increasing the debt to GDP ratio, all debt together, just drifting slightly up due to technology. And then the technology, I mean the introduction of more and more sophisticated financial instruments, but not rising dramatically. And then in 85, it kills to a 45-degree angle and shoots across any page and goes from about 1.1 times GDP to well over 3. So in that little window of 35 years, we triple the debt to GDP ratio. It's a big chunk of time. It's the biggest, most important economy on the planet, a pretty good test. So what happens to growth? It inflects downwards. And from 85, we grow more slowly. Grant you, there are many other factors at work. It's a complicated picture. But there is little room in that equation for the idea that more debt creates more growth. It is not proven in the data. It is held to be the case. It is an assumption like most of modern economics, but it is not proven by the data. I would suggest that there is no evidence at all that increased levels of macro debt to GDP have anything to do with growth. They have everything to do with higher risk, though, from time to time.